In accrual basis accounting, revenues are recognized when they are earned and expenses when they are incurred. As a result, companies need to make adjusting entries. Businesses need feedback about how well they are performing during a period of time. For example, management usually wants monthly reports on financial results. Most large corporations are required to present quarterly and annual financial statements to stockholders. The Internal Revenue Service requires all businesses to file annual tax returns. Accounting divides the economic life of a business into artificial time periods. As indicated in the previous chapter, this is the periodicity assumption. Accounting time periods are generally a month, a quarter, or a year. Companies often report using the calendar year, so January 1st to December 31st. But sometimes a company chooses a different 12-month period, for example, August 1st to July 31st. When a company agrees to perform a service or sell a product to a customer, it has a performance obligation. The revenue recognition principle requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. This typically occurs when goods have been delivered or the services have been performed. Let's assume Conrad Dry Cleaners cleans clothing on June 30th, but customers do not pick up and pay for their clothes until the first week of July. Under the revenue recognition principle, Conrad records revenue in June when it satisfies its performance obligation, which is when it performs the service. At June 30th, Conrad would report a receivable on its balance sheet and revenue in its income statement for the services performed. In July, it would recognize the collection of the cash. Revenue recognition results from a 5-step process. This process can be best illustrated with an example. Let's assume that Sierra Corporation signs a contract with a customer to provide guided services for $1,500. This image shows the 5 steps that Sierra follows to recognize revenue. Step 5 is when Sierra recognizes revenue related to providing the guided services, because at this point, Sierra completes the trip and satisfies its performance obligation by performing the service. In recognizing expenses, a simple rule is followed. Let the expenses follow the revenues. Expense recognition is tied to revenue recognition. Let's revisit our previous illustration, Conrad Dry Cleaners. They would recognize salary expenses incurred in performing the cleaning service on June 30th in the same period in which it recognizes the service revenue. The practice of expense recognition is referred to as the expense recognition principle, often referred to as the matching principle. It dictates that efforts or expenses be matched with the results or revenue. The revenue recognition principle and the expense recognition principle help to ensure that companies report the correct amount of revenues and expenses in a given period. GAAP requires companies to record revenue and expenses in the periods in which the events occur, not when cash is received or paid. Accrual basis accounting means that transactions that change a company's financial statements are recorded in the period in which the events occur, even if cash was not exchanged. For example, using the accrual basis means that companies recognize revenue when they perform the service, even if cash was not received. Likewise, under the accrual basis, companies recognize expenses when incurred, even if cash was not paid. And again, when we are using the accrual basis, we are in accordance with GAAP. An alternative to the accrual basis is the cash basis. Under this method, company records revenue at the time they receive cash. They record an expense at the time they pay out cash. This cash basis seems appealing due to its simplicity, but it often produces misleading financial statements. As a result, cash basis accounting is not in accordance with generally accepted accounting principles. Fresh Colors paints a large building in 2019. During this period, it incurs and pays total expenses, which represent salaries and paint costs, of $50,000. It bills the customer $80,000, but does not receive payment until 2020. On an accrual basis, Fresh Colors reports $80,000 of revenue during 2019 because that is when it performed the service. The company will match the expenses of $50,000 to the $80,000 of revenue so that in 2019, net income is $30,000. It would report no income in 2020. If Fresh Colors instead used cash basis accounting, it would report $50,000 of expenses in 2019 and $80,000 of revenue during 2020. It would then report a loss of $50,000 in 2019 and net income of $80,000 in 2020. Clearly, the cash basis measures are misleading because the financial performance of the company would be misstated for both years. Financial statements created under the cash basis accounting normally postpone or accelerate recognition of revenues and expenses. In order for revenues to be recorded in the period in which the performance obligations are satisfied, and for expenses to be recognized in the period in which they are incurred, companies make adjusting entries. Adjusting entries ensure that the revenue recognition and expense recognition principles are followed. Adjusting entries are necessary because the trial balance may not contain up-to-date and complete data. Adjusting entries are required every time a company prepares financial statements. The company analyzes each account in the trial balance to determine whether it is complete and up-to-date for financial statement purposes. Every adjusting entry will include one income statement account and one balance sheet account. The entry will either debit an expense account and credit a balance sheet account, or debit a balance sheet account and credit a revenue account. Adjusting entries do not involve cash. Adjusting entries are classified as either deferrals or accruals, and each of these classes has two subcategories. We will discuss both of these adjusting entries in detail in the next learning objectives. To illustrate adjusting entries, we will revisit Sierra Corporation from the previous chapter. This is their trial balance at October 31st. We need to analyze each account to determine whether it is complete and up to date. Please note that retained earnings has been added to this trial balance with a zero balance because this is its first month of operation.